Welcome to the deep dive. Today we're looking at a classic corporate headache. You pull off a huge necessary tech upgrade and boom, your short-term results just fall off a cliff.
Yeah, it's a Clorox story for Q1 fiscal 26. We're digging into those results.
It really wasn't just a tough quarter, was it? It felt more like a planned demolition followed by a rebuilding project.
That's a good way to put it. It's the cost of laying down that new digital foundation.
Yeah.
And the core thing here, I think, is figuring out how much pain was necessary versus how much might be, actual market weakness.
Right, because the headline numbers were stark. For the quarter ending September 30th, 2025, net sales dropped 19%.
And volume fell 18%.
And diluted EPS also down 19% year over year, fell to 65 cents from 80 cents.
That consistency, that 19% across key metrics, it really signals a big temporary shock to the system.
Okay, so the main culprit was this big ERP rollout, their enterprise resource planning system in the US.
Exactly. Their new digital backbone. They called it a major milestone. And long-term, it probably is. But short-term, oof.
Big speed bump, as you said. They were pretty clear the volume drop, that 18%, was mostly due to temporary challenges from the switch.
Yeah, it's all about timing. They actually shipped extra products in the quarter before this one, Q4 of fiscal 25, kind of bracing for the changeover.
Ah, okay, so they pulled sales forward.
Right, and then in Q1, the retailers just worked through that extra inventory they already had, so shipments cratered.
And Clorox actually put a number on that timing shift, didn't they? This is the fascinating part.
They did. They estimated that just the timing shift related to the ERP cut diluted EPS by 90 cents per share.
90 cents.
Wait a second. They reported 65 EPS. If you add back 90 cents.
You're looking at underlying operational EPS closer to, what, $1.55?
Exactly. It completely changes the narrative for the quarter. It suggests the core business was actually performing pretty well underneath all that noise. That's the key takeaway they pushed. They basically said, look, we knew Q1 would hurt because of this transition. It was a strategic sacrifice.
And it wasn't just the sales impact. This whole digital transformation has a big price tag.
Oh, yeah. Around $580 million over 5 years. And in this quarter alone, they've got $32 million in operating expenses tied to it.
Which flows right down to margins, right? Gross margin fell 410 basis points, dropped from almost 46% down to below 42.
Yep. Lower volume was the main driver, but they also called out higher manufacturing and logistics costs, specifically because of the disruption, getting the kinks worked out of the new system.
And that pain was felt everywhere. It wasn't isolated. Lifestyle segment, that's food, Brita, natural personal care, saw the biggest sales drop, down 23%.
Health and wellness, household, both down 19% too.
Yeah.
It really hit across the board. Seems like the more complex bits of the business maybe struggled more with the system change.
Okay, so that covers the internal disruption. But what about the market they're stepping back into? What's the consumer mood?
Well, management keeps stressing that consumers are still feeling the pressure. Volatility, uncertainty, it makes them very value-seeking.
So people are looking for deals, maybe trading down.
Pretty much. And while Clorox says the overall competitive space is fairly rational,
Uh-oh, I sense a butt coming.
well, they immediately follow that by noting increased promotional activity in some big categories, like Glad trash bags and their cat litter brands, Fresh Step and Scoop Away.
Okay, so fairly rational, except where competitors are getting aggressive in their core markets. That seems optimistic.
It does raise an eyebrow, doesn't it? Especially since they admitted the ERP issues caused more market share loss than they expected, particularly back in August.
Yeah.
They need to win that share back fast.
So how do they fight back in this value-focused environment?
Their big strategic lever is something called price pack architecture, PPA.
Right, PPA. Basically offering different sizes at different price points to appeal to different shoppers.
Exactly. It's about meeting the consumer wherever they are on that value spectrum. Think salad dressing, they said the category is down a bit.
Okay.
With PPA, they can offer a big bottle, best value per ounce for the heavy user, but also a smaller, more affordable bottle for someone just stocking the pantry on a budget.
Makes sense. Cover both ends.
And look at Brita water filtration. They're seeing pressure from private label filters.
Cheaper options flooding in.
And so they're updating their pitchers, but crucially, they're launching smaller sizes for both pitchers and filters. The idea is to give people an affordable way to stay with the Brita brand, rather than switching away entirely.
But does that risk lowering the average amount people spend each time they buy? Defending share, but maybe hurting value long term?
That's the potential trade-off, absolutely. It's a balancing act.
So looking ahead, how do they see things playing out? What's the recovery plan?
Their baseline assumption is that the overall U.S. retail market stays pretty slow, like 0% to 1% growth, below normal but stable, because they're in essential stuff like cleaning and pet care.
Okay, muted market growth. And their own sales outlook, if you strip out that Q1 ERP noise.
They expect organic sales to still be down slightly low single digits in the first half of the fiscal year overall.
Then?
Then they're calling for an inflection, positive low single-digit organic growth in the back half, H2.
That's a pretty confident turnaround. What's driving that?
Two main things, they say. First, innovation. Big product launches planned across their major brands for the second half.
Okay, what kind of innovation are we talking about? Game changers.
Well, they mention things like new scents for Glad trash bags, like Bahama Bliss, the modernized Brita pitchers we talked about, and Burt's Bees expanding a balm line into body lotions and butters.
New scents and smaller filters. Is that really enough to drive significant growth against tough competition and promotions?
That's the million-dollar question, isn't it? They believe these things offer superior value, backed by strong marketing. But yeah, you have to wonder if it's enough differentiation.
What's the second lever for the H2 recovery?
Simpler math, really. They'll be comparing against weaker results from the second half of the previous fiscal year. The comparisons just get easier.
Lapping easier comps. That always helps the growth percentage look better.
Definitely. And they say they're sharpening their ad spending, using personalization tools to get better ROI, which they claim is already industry-leading. They need that efficiency.
Speaking of needing efficiency and cash, there's another big financial item looming, isn't there? Something with Glad and P&G.
Yes, that's important context. The joint venture agreement they have with Procter & Gamble for the Glad bags and wraps business, where P&G owns 20%, is ending.
When does that happen?
It terminates in January 2026, and Clorox is required, contractually, to buy out P&G's stake for cash.
Okay, how much cash are we talking about?
As of the end of Q1, the estimated fair value was $476 million, nearly $500 million.
Wow. So that's a big cash outflow they need to plan for right in the middle of this hopeful H2 recovery.
Exactly. Makes generating strong operating cash flow even more critical in the coming quarters.
Is there any good news on the cost side that might help fund this? Inflation may be easing up?
Actually, yes. Bit of relief there. They lowered their forecast for full-year inflation and input cost increases. Initially, they expected a $90 million hit.
I know.
Now they're projecting $70 million, so a $20 million improvement. Commodity and supply chain costs are looking slightly more favorable, as they put it.
That helps, but it's not massive, and they still have tariffs.
Yep, $40 million in tariff costs remain a headwind. So some cost relief, but not a complete game changer.
And just quickly, they've also been trimming the portfolio a bit, right? Selling off non-core stuff.
Yeah, smaller moves, but strategic. They completed the divestiture of their vitamins and supplements business, Better Health VMS, back in fiscal 25. It shows they're trying to focus on the core brands while juggling this huge ERP project.
Okay, so let's try to wrap this up. We've got a company, Clorox, that took a deliberate massive hit in Q1 because of a successful but disruptive ERP implementation.
Right. They quantified that, hit that 90 cents per share pretty clearly, suggesting the underlying business wasn't as bad as the headlines looked.
But now they face the challenge of recovering that lost sales volume and market share in a tough environment where consumers are hunting for value.
And competitors might be getting more promotional despite management calling the overall scene fairly rational.
Their recovery plan hinges on a second-half turnaround, driven by innovation, new scents, smaller sizes, line extensions, and easier year-over-year comparisons.
Plus some help from slightly lower than expected inflation, which gives them a bit more margin to play with for marketing and funding that Glad buyout.
So the core confidence seems to stem from knowing the ERP disruption is mostly behind them and having some cost control.
But the big question for you, the listener, is whether that innovation pipeline, the Glad Bahama Bliss, the smaller Britas, is truly compelling enough to win back consumers who might have strayed, especially when competitors are dangling discounts. Is it really superior value?
And maybe the most provocative thought here, Clorox feels the competitive environment is fairly rational. But what if it isn't? What if competitors see Clorox as operationally focused and decide now is the time to really turn up the promotional heat in trash bags or cat litter?
Exactly. If they get dragged into a real price war to regain that lost share, especially the share lost in August,
then that careful H2 margin recovery plan needed to fund innovation and that P&G payment could evaporate really quickly.
That's the tightrope they're walking right now. Balancing operational recovery, market share recapture, innovation funding, and a major cash payout, all while hoping the competition plays nice. It's going to be an interesting few quarters to watch.